All right. Hello, everyone. Thank you so much for joining us today. My name is Andrew Swinney. I'm the Chief Marketing Officer here at Leader Bank, and I'll also be your MC for this webinar. That said, it is storming here, so I disappeared once already. If the power goes out, then I won't be your MC, but hopefully that doesn't happen. Before I pass the mic over to our actual presenters, I did want to do a little bit of housekeeping. So first of all, this session is being recorded, and we will make sure to send out a copy of this recording afterwards. Please feel free to send it around, or if anyone else would like a copy, send us the information. We're happy to pass that along. Also, since it is being recorded, you'll notice that the microphones and cameras have been disabled, but that doesn't mean that we don't want to hear from you or answer your questions or interact. So if you do have questions during this presentation, please feel free to use the chat or the QA. I'll be watching it, and we'll definitely reserve time at the end to go over those questions. All right, with that taken care of, I'm going to pass it over to our actual presenters. Jim, Kayla, do you guys want to introduce yourselves?
Yeah, thanks, Andrew. And first and foremost, thank you everyone for attending. It takes time, to step away from our day-to-day and invest in ourselves. So I'm Kayla Frerking. I'm one of the vice presidents here with Leader1031, and Jim's here as well. So first and foremost, we are a qualified intermediary. We're a subsidiary of Leader Bank, which you gathered from our email invite. And we do offer our services in all 50 states, which is fantastic. So we are a national qualified intermediary. Starting off, I want to just stress heavy here that we do not give legal tax advice. Please consult your CPA or financial advisor for the intricacies of how you file and your specifics of your capital gains taxation. Today, we're going to give an overview of 1031 exchanges and the Internal Revenue Code, and really the intricacies, and see if they pertain to you and how we can benefit you with the tax code. So, Jim, do you want to say a couple words?
Thanks, Kayla. I just want to let you know, I've been with Leader 1031 for a couple of years now. I've been a bank qualified intermediary for over 20, and appreciate everybody joining us today, and hopefully we'll be able to provide you some knowledge and some insight, perhaps directly related to your transaction and your tax situation.
Perfect. Thanks, Jim. Just like Jim, I've been here for a couple of years. I've been in the 1031 space for almost a decade, in real estate for 15 years. Come from a family of real estate investors, and we love calling Leader 1031 home. So our contact information is up there on the screen. Our cell phone numbers are there, and our emails. And you'll also, again, receive more information after our presentation, so you can contact us with your special and specific 1031 exchange questions. So I always like to start out with a knowledge check to read the Zoom room, if you will. See where we're feeling good, what our interests are in 1031, and if we've done our Google search of any tax code terminology. So if you do have an answer, please type it in the chat. I would love to hear from you and kind of get a read on this Zoom room. Does anyone know what IRC stands for? I may have let this slip already if you were listening. I'll pause for a second to see if anyone types in the chat. No takers. I don't think we have any takers. So IRC is Internal Revenue Code. Okay, so when we talk about IRC Section 1031, it's Internal Revenue Code Section 1031 of our tax code system. So some people ask us, oh, 1031, are you specializing in Halloween? Absolutely not. We're specializing in our tax code provision, Internal Revenue Code Section 1031, which falls in line with exchanging real property held for investment purposes. Now, does anyone know when Internal Revenue Code Section 1031 was added to our tax code system? I'll pause again if you want to enter, maybe take a crack at a guess on the year. All right, I got no takers on this one either. That's okay. See people joining still. Okay, that's great. So actually, IRC Section 1031 was added as a tax code in 1921. That's wild. So we have over 100+ years and going on 1031 exchanges. So you are not the first person intrigued with 1031, and you will not be the last. So timelines of an exchange. Does anyone know when the exchange period ends? For those of you who are familiar or maybe have done an exchange in the past. Ooh, someone's typing. I got 180 days. Thank you. Omar, thanks for participating on that. You are correct. So 180 days in the entire exchange period. And that means from the settlement date of the relinquished property begins a timeline of 45 calendar days to identify or declare replacement property, plus an additional 135 days to close should you need it, totaling an entire exchange period of 180. The 45 plus the 135 gives you 180 in that entire timeline. And yes, 6 months as well. Thank you for participating. I appreciate it. Does anyone know, for my final question here, what is the maximum amount of capital gains taxes you can defer when performing a 1031 exchange? We have people typing. I'm so excited. Someone said 500K. Omar is correct. It is, and Bridget too. So it is unlimited. Correct. It is sky high. If you have gain in the amount of 100 grand, you can exchange it and defer it. If you have gain in the amount of 100 million, exchange it, defer it, right? Let's defer those capital gains taxes and redeploy our investment in more real estate. So for those of you who are not too familiar on 1031s, I want to start out with two different versions of how we can deliver and comprehend 1031. First, you start out with a traditional sale, your general real estate transaction. You sell investment property and you receive cash. When you receive cash in a traditional sale, you're triggering a taxable event. Where in a 1031 exchange, the taxpayer is listing real estate for sale in exchange for more real estate. So you're not receiving cash, you're receiving real estate, thereby deferring capital gains taxes. So we're eliminating actual receipt of funds or constructive receipt of funds by preparing a proper 1031 exchange and engaging in IRC Section 1031 rules and regulations. This specifically is one of the single greatest wealth building tools available to real estate investors. And as you heard me say, 100K or 100 million, we're looking and focusing on exchanges on the small end and the large end. So it benefits all taxpayers in the United States across the board, exchanging across all 50 state lines. Another way to say this is directly from the tax code. It states no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment, if such property is exchanged solely for property of like kind, which is to be held either for productive use in a trade, business, or for investment. Right? So that is just a mouthful, right? When we look at that and I break it down into 3 bullet points, it's the sale of one investment property or more, followed by the purchase of another investment property or more, facilitated by the qualified intermediary or the 1031 exchange company in the middle. That's Jim and I, or Leader 1031. So our role here is to hold those sale proceeds in between the disposition of one investment property and the purchase of one or more, okay? Now, when we're focusing on who the clientele that we help out is all of you on this call today, investors. We're looking to delay that recognition of capital gains taxes, right? When we're delaying it, that common question comes up. Well, when do I actually have to pay it? Well, we have a morbid term that we like to poke fun at and giggle a little bit. I see Jim smiling right now. So we say you swap till you drop, you exchange until you die, right? Just keep rolling those assets, maybe growing your portfolio, diversifying, so that when you pass away, your beneficiaries get a step up in basis. So the fair market value of their inheritance properties, they can outright sell and pocket that cash. So it's almost life estate planning. If you were to liquidate, or what I like to call is cash out of an investment property that's been exchanged, you would thereby be paying capital gains taxes all the way back to your original basis or the original purchase price. So either don't pay them at all, right? And roll until you pass away for inheritance purposes. Or number 2, when you liquidate or touch the money and have actual receipt of funds. What is our role? right? As I mentioned, we're in the middle. We hold those funds, but of course there's more to it. We create a 1031 exchange agreement, an assignment of agreement, a notice of assignment, exchange account forms, and we instruct closing attorneys, title companies, escrow companies, all about our detailed closing and operations. And sometimes people are in the dark about the tax code, and that's okay. We educate them as well as we go through the process, and we support you as our taxpayer exchanger in the process. So a takeaway here, the assignment that we create, which is our document, is the most crucial form that we have. This has to be prepared prior to the settlement date or recording date. We're thereby entering into contract on behalf of our exchanger to receive those sale proceeds. If you've recorded on a Friday and you call us on a Monday and you're telling us, hey, let's set up an exchange this Monday, I closed on Friday, we can no longer set up the exchange. So please stop the contract in its tracks before you have a recording date. Contact us so we can set up a 1031 exchange for you prior to that close date. Now here at Leader 1031, we are also backed by a stamp of approval of the Federation of Exchange Accommodators. It's a mouthful. So when we're looking at that stamp of approval, we're first to know disaster extensions, what's happening in the Senate, right? What's happening in the House. So we're very up to speed and educated with what's going on in the 1031 world. And of course, as you know, Leader 1031 being backed by Leader Bank, we're a member of the FDIC. So we're almost level 3 top tier of what we're looking at as the top tier qualified intermediary. We have FDIC and the FEA, and we have all segregated accounts, of course, and we're operating in all 50 states. So it's a win-win-win. Now, as we're looking forward in terminology, I covered IRC section 1031. The relinquished property is the property being sold. The replacement property is the property being purchased. Now, the qualified intermediary, as I mentioned, is us, Leader 1031. We're the facilitator or accommodator, other terms we've been called. We're that company in the middle that holds those sale proceeds under safe harbor regulations of our tax provision system. That identification period is 45 calendar days. As I mentioned, and Omar mentioned, we have 180 days for the entire exchange period. And within the 45-day window at the start of that 180-day timeline, you have identification rules. Of course there's rules, right? This is the IRS. So the most commonly used rule is the 3 property rule, which allows an investor to sell investment property and identify up to 3 replacement properties. That doesn't mean they have to close on all 3, but they can should they wish. So it's an opportunity as a backup plan or diversification. Next, we have boot. Just like on your feet, when you buy Lucchese's, you pay a ton in taxes, right? So those are tangible. Those are personal property. Same thing applies if you have cash that's left over in exchange and doesn't go from real estate to real estate. So boot can be in the form of cash, or it can be in the form of mortgage or debt relief. So if you don't replace debt, you're also paying taxes on that debt unless you've offset debt by infusing your own personal cash. And we'll dive more into what that looks like in an equation when Jim covers our format and equations. And I see a flood of questions coming in. If you guys don't mind putting them in there, we're going to answer a ton of them at the end as well, just so that we can be engaging and get through the presentation we have. And hopefully we can answer your questions when we're going through. That's our goal and our hopes today. So the like kind property, this is my favorite slide. What is like kind? I'm exchanging real estate held for investment for more real estate, right? Well, I can take maybe a beneficial interest in a Delaware statutory trust, which is an alternative investment, in exchange into a commercial building. Let's call it office space. I can take my tenancy in common, my fractional interest, and exchange that into land. I can take land and buy a vacation rental. I can take my vacation rental and buy oil rights, mineral rights, wind turbines, a 2-family, 3-family, 4-family. So all of these are exchangeable for one another. So when you own commercial real estate, and maybe you're trying to get out of commercial real estate, you're not stuck with going back into commercial. If that's your dream and you love commercial, there's multiple ways to own replacement commercial. Tenancy in common, as I mentioned, DSTs, alternative investments. But keep an open mind here because like-kind is extremely broad. So it's a win for exchangers to go across the board. Now in 2018, there was an elimination of personal and real property to just real property. So you could have exchanged this vacation home in Vermont, right, for a boat. You can no longer do that. So remember, it's real property held for productive use in a trade, business, or for investment. So your intent has to have it operating, of course, as an investment purpose. So just a broad overview before I pass the baton to Jim here for a moment. I want to talk about the timeline of an exchange and what actually happens, right? When we look at the timeline of an exchange, you start out with an exchanger. As I mentioned, that's interchangeable, the taxpayer, you. The person who owns investment real estate lists that property on the market for sale. A buyer comes in, you sign a P&S, it's fully executed, and we are contacted at Leader 1031. Once we approach that settlement close date, those sale proceeds are wired into a segregated account held by Leader 1031. We hold those sale proceeds within certain regulations and restrictions of the tax code provision. You find replacement property abiding by Internal Revenue Code Section 1031 rules. Request a wire. We send a disbursement form to release on your behalf. Signatures go on it by you. Those sale proceeds go out to the new title company that's holding that escrow account in between your purchase and the seller. And we direct deed title back to that exchanger, you. So what we're doing here is holding those sale proceeds. Again, I can't stress that enough, how simple the concept is. We're here to provide that safe harbor in those segregated accounts. And when we look at those regulations and restrictions, I covered briefly, but at the bottom of your screen here, we have 45 days to identify. Now, if you do not find property within 45 calendar days of identifying, we get a call from you and we let you know, hey, it's day 45, we haven't had an ID, and day 46 approaches. That morning, you let us know you could not identify. That's okay. What happens here is a blown exchange. On day 46 in this event, we would then wire sale proceeds back to you. And of course, you're facing a taxable event, which we're trying to avoid. The goal here in a positive is, hey, we're preparing for a perfect storm 1031 exchange. As mentioned, that ID rule, the most commonly used rule, is the 3 property rule. Let's say you do ID 3 properties. Once you've spent all of the money or closed on properties you've ID'd, you've thereby completed an exchange. So here's an example. If you ID 3 properties and the first one requires all of your sale proceeds to be used, and you close on that first property, say on day 70 of the 180-day timeline, you've now completed the exchange. The other 2 properties are irrelevant and were used as safety nets or backup plans. And of course, you have that 180 days should you need it. I'm going to pass the baton here to Jim to talk about equations.
Thanks, Kayla. What we're going to talk about first is what we would look for in to have a completely fully deferred exchange. The taxpayer must meet 2 requirements. And the first is to reinvest the net equity, which is basically your sales price minus allowable closing costs and any outstanding mortgage that might be there. And then you also need to acquire property with the same or greater debt. So our example here is we've got a sale price of $1 million. Go to closing, the debt of $400,000 is paid off at closing, leaving us with net equity of $600,000. And that $600,000 is what's going to come into the qualified intermediary and be what we refer to as exchange funds. And those funds can be used for the acquisition of properly identified replacement property, including the earnest money deposits that might be required on those acquisitions. So we've targeted a replacement property with a value of $1.2 million. And we go to closing. So the acquisition of that's going to take our full $600,000 in net equity, and it's going to take $600,000 in debt. So we've gone equal on our net equity, and we've actually gone higher on our debt. Says, as a result, this is a fully deferred exchange is going to result in zero boot. So there's not going to be any taxable responsibility for the taxpayer on this, and they simply have to report it on their tax return on Form 8824. The IRS also allows what we call a partial exchange, and sometimes this is planned, sometimes it's not. In a case like this, the taxpayer might end up acquiring property that's slightly lower in value, or slightly lower in debt, or slightly lower in net equity, or lower in all of them. So again, in our example where we've got $1 million in value or $400,000 in debt, the $600,000 goes into the qualified intermediary. So in this case, our taxpayers only identified a replacement property with the value of $700,000. Perhaps they couldn't find a suitable replacement property worth $1 million. And they reinvest $260 in debt, $400 out of the $600,000 in net equity, or $440 out of the $600 in net equity. And in this case, we're going to have $140,000 in mortgage boot and $160,000 in cash boot, resulting in total boot of $300,000. Now, there are times in this where people might actually intentionally do a partial exchange. And I have clients do this all the time, where they'll take out, say, $100,000 from the closing on the sale of the relinquished property, knowing it's going to be fully subject to tax. But perhaps they've got college tuition due or other expenses they know that they're going to utilize those funds for, knowing that those funds are going to be fully subject to taxation. Speaking of taxation, why we do this, the capital gains tax. So first, there's multiple levels of capital gains tax, first of which is depreciation recapture. Any depreciation that has been taken on that property while you've owned it is going to be subject to recapture tax of 25%. There's no getting around that. It doesn't matter what your tax rate is. It doesn't matter where you are in earnings. Your depreciation recapture is going to be at 25%. The second tax is the net investment income tax, medical surtax, also known as Obamacare tax. And this is a 3.8% tax on unearned income, which includes the gain on sale of real estate. The next level is just your federal capital gains rate. And this one is actually based on your earnings. And in most cases, taxpayers going to be in the 15 or 20% tax bracket. There are lower cap gains percentages, 0 and 5%, but that is very, very low income threshold that most people don't qualify for. And at this, then of course, you're going to have your applicable state level tax. This can range from 0 in states like Texas and Florida, 5% Massachusetts, up to the top level in California at 13.3%. So if you've got a property in California that you sell instead of doing an exchange, you're probably going to be somewhere at about 36 or 37% taxation on that property. So you're going to lose a third of your profit easily right off the top. So a recap on this, and I think the easiest way to remember the fully deferred exchange is equal or greater in value and equal or greater in equity. So as long as you sell for $1 million, you buy for $1 million, you're great. If you get $600,000 in cash and you spend $600,000 in cash, you're great. And when you hit both of those, you're going to have a fully deferred exchange. And it's really pretty straightforward. And I forgot to mention earlier, you can replace debt with additional equity. Most real estate investors never going to do that, but it is allowable. If for some reason you're in a situation, maybe in this market right now where we've got high interest rates, you might have a penchant to put a little more equity in the deal. And then when interest rates hopefully drop in the near future, we can refi that property, pull out a little equity and get us at a point where you've got the cash back in your pocket and lower interest rates. So as we mentioned, the partial exchanges are allowable. We refer to that taxation as boot. Again, the clients I mentioned that took the cash out, in some cases know that they have losses that they can take advantage of in a given tax year. So they may take that boot out intentionally, knowing the losses they have can help offset the gains they're going to get from taking that boot from closing. Again, very important to talk to your tax advisor, and it goes beyond just discussing the 1031. Like I said, you may have other situations where you can mitigate the impact of this tax because of other situations of your investments, whether you've got real, stock losses or other, business losses that might be able to help offset that gain. And it's also important, I think, as kind of Kayla mentioned on the drop till you swap, is to make certain your estate planning attorney and your transactional attorney work hand in hand on these transactions, because everybody's got to know what's going on and get the big picture involved, so you know the long-term ramifications of what you're doing. A further issue that we need to discuss is the same taxpayer rule. And this can get a little messy when you've got a partnership, let's say, where the partners want to go their own way. Because the IRS requires that the taxpayer who owned the relinquished property has to be the taxpayer that acquires the replacement property. So if the partnership owns the relinquished property, partnership has to buy the replacement property. Corporation owns relinquished property, corporation has to buy the replacement property. Now this can get a little, there's a little wiggle room, I'll call it, when it comes to the individual taxpayer, because the individual's grantor trust, the individual who owns a single member LLC that's disregarded for tax purposes, are all considered the same taxpayer in the eyes of the IRS. So if that tax return, that this property's income is flowing directly through the tax return with your Social Security number, the relinquished and replacement property can be in any one of those forms, whether it's individually, name your trust, name of the single member LLC. So there's a little wiggle room there, as well as community property states where you've got a husband and wife LLC that could be similarly considered the same taxpayer. When it comes to the actual fee ownership of the property, 100% fee interest in a property when you sell is like kind to a 20%, say, tenancy in common interest. So you don't have to have that exact 100% to 100% fee ownership. The 20% tenancy in common ownership would qualify as well. So now we're going to touch just very briefly on reverse exchanges or parking arrangements. We could spend 3 hours discussing the details of a reverse exchange. What we've been discussing so far is what we'll call a forward exchange or a deferred exchange or simultaneous exchange, whatever. It's sale then purchase. In most cases, the reverse exchange is purchase then sell. And the IRS allows this, but they also do not allow you to own both properties at the same time. So we need to hire a third party to park the property until the taxpayer sells what it is they're selling. And basically, in a nutshell, an LLC is created to acquire that property. The purchase and sale agreement is assigned to that property. The property is acquired and held there until you sell your relinquished property. And then the same steps we just discussed would happen. The money comes into the qualified intermediary. Then the qualified intermediary would acquire this parked property to complete the exchange. Many times this is a situation where it's a timing issue, where you think you're going to close on your sale, the sales closing is delayed. Now you got to close on your purchase. It can get a little messy. Obviously, the biggest issue is the financing issue. Does the taxpayer have the wherewithal to acquire the park property without utilizing the proceeds from the sale of the relinquished property? And for the most part, that eliminates a lot of people from being able to do the reverse exchange. But larger companies, REITs do this on a regular basis. Large companies that own a significant amount of real estate utilize reverse exchanges on a regular basis. They are much more complex. They are also much more costly. For example, the forward exchange we spoke about, our typical fee is $1,250. On a reverse exchange, you're probably going to be starting $6,000, $8,000, possibly higher, depending on the actual transaction. And that's not including the cost of creating the LLC. So like California, that's going to be another, $800. Michigan, it's 50. You know, it varies state by state. There's other types of exchanges that fall under the reverse exchange rules. They're known as improvement exchanges and build-to-suit exchanges. An improvement exchange, a good example, if you go back to our partial exchange that we had where they sold for $1 million and bought for $700,000. If they bought that property that was $700,000 and it needed $300,000 of improvements, they could have structured this as an improvement exchange and avoided the capital gains tax on that $300,000 shortfall. What would have happened there is the replacement property would have been acquired as part of a reverse exchange. Then the improvements would have been completed during the 180-day time period. And at the end, the taxpayer would have had a $700,000 purchase price, $300,000 in improvements. And when the property was conveyed to them to complete the reverse exchange, they then would have a completely deferred exchange. The build-to-suit sounds exactly what it sounds like. It's like a ground-up exchange. You know, the land is purchased, construction starts. Obviously, the big limitation here is our 180-day construction period. The IRS does allow for partial completion of exchanges. So if you think, you know, in 6 months I can get 45% of my building completed, and that's enough to meet your, you know, equal or up in value, it may make sense to do a build-to-suit exchange. There are, again, this is a very brief overview of this, and we could, if you have any questions regarding any of this, but this specifically, we can have a one-on-one conversation because it will take a while to go through the ups and downs and ins and outs of this.
That's the fun part, though.
Yeah, exactly.
Well, as we near our finish here, we want to talk to you a little bit about why Leader 1031. As I mentioned early on, and if you caught it, qualified intermediaries are non-regulated on the federal level. At Leader 1031, we're backed by a financial institution, Leader Bank. So we have segregated accounts that are set up for each individual exchanger, never commingling funds. When a wire comes in and goes out, we are tracking it and we are monitoring and sending you updates throughout that process. I also mentioned the FEA. We are part of the FEA. We're attending the second annual conference as Leader 1031 Workforce in September. We always get up-to-date disaster extensions. We're in the know, and we have this beautiful stamp of approval. Do your due diligence when interviewing a qualified intermediary. Ask the tough questions. Where's the cash being held? That's the most important question. Jim and I have both worked for other qualified intermediaries, and I mentioned it early on, this is home to us because the security of funds. It's easy to pitch a product and what you do when you have the security of funds, and it speaks volumes for itself. So we're here to help you and keep that safe harbor regulations and your funds safe and secure at Leader 1031. So a quick overview and key points to remember before we open it up for questions. Once you're in contract with a fully executed P&S, contact Leader 1031 to open your exchange. Of course, Jim and I both love doing all of the conference calls, consultations beforehand. They're free. We just want to chat with you and see what's going on and see if we can help and put these puzzle pieces together. That exchange must be set up, meaning that exchange agreement, the assignment, prior to that closing of the relinquished property. Of course, you have to purchase like-kind investment property, cannot be a primary residence. I do want to note there, if you do an exchange into residential and hold the residential property for 2 full calendar years, you can then claim it as a primary on the 3rd calendar year and move into it. So there's another win. 45 days to identify the new replacement property or properties, plus an additional 135, totaling 180 days in the entire exchange period. Extensions are given, but they're a disaster extension. So sometimes it's not necessarily a win for the taxpayer and causes stress or wear and tear, especially on that property, depending on where it's located. Typically that 180 is in stone. You have to reinvest the net equity and acquire a property with the same or greater debt. So net plus debt to find the new property, and you're off to the races for a perfect storm 1031. So that wraps it up. Here's our email address, info@leader1031.com, our website, and you have our contact information. So I do want to give a moment here to scroll up. Jim, if you want to check out any of these that we haven't seen and Andrew's
I've
coming
got a
up
bunch
too,
of
which is
questions
awesome.
here for you, so I can
Yay!
help you navigate those. I'll probably
Thanks.
read through all of them, even the ones that Jim has already answered, just so that everyone can benefit from those. All right, so one of the first questions we heard was, is there any way to extend the 180-day period?
No.
Perfect,
Simple,
concise,
simple.
clear.
It is.
No.
It's etched in stone. It's calendar days. Literally, the only way you can get an extension is there is a federally declared disaster, hurricane, flood, something horrible where the federal government has declared, not state, federal, has made a declaration, and typically that's going to apply that's going to supply a 120-day extension in most cases. There's very specific. What's nice is IRS actually puts this out on their website, and it's fairly easy to find, but there's also some, well, does this apply to me question. So this is definitely one of those ones where the tax advisor is going to step in.
Cool. The next one is a 1031 established per property?
Yes, but you can do an exchange with multiple properties. Let's say, for instance, you have a portfolio of 5 single-family residential properties, and you sell them all to one person. In that kind of case, it would be real easy to do a single exchange, but you're going to have to collectively buy replacement property that is equal or higher in value to the combined sale price and use the combined equity to go towards that replacement property. You can also sell a single property and buy multiple properties. What we've got to look at is, the allocation of tax basis on some of those properties. It can be done, but yeah, it gets a little messy, but it's easier. You have a pro and con, because if you put all 5 into one exchange, you only get to identify 3 replacement properties. However, if you do 5 separate exchanges, you can identify 3 properties for each of those single exchanges. So there's pros and cons. Obviously, a pro would be also lower cost to do it as a single exchange.
That makes sense. There's a lot of strategy, and the answer is always, it depends. But technically, yeah, there's some options there.
It's all timelines, right?
Yeah, totally. Is it possible to close on the old and close on the new property on the same day?
Yes, simultaneous exchanges are allowed. I'll be honest, I discourage them, because if something goes wrong with the first closing, you're going to have to reschedule the second one too. And it also makes for a little bit of panic. What happens if your first closing that was supposed to be at 10 a.m. ends up taking place at 3 p.m. and you've only got the documentation in place? I usually encourage people to do it maybe 2 business days apart. It just makes life simpler for everybody, and then you don't have to scramble to reschedule.
So possible, but riskier and more stressful. But if that's what you like that adventure, then it's technically possible.
Yeah, and I've only seen it happen a couple times, but if one office is handling both closings, it makes it a lot easier. But that very rarely happens. Usually, you've got one in California, one in Texas, or whatever it happens to be.
Yeah. Next question: does an investor have to hire someone to assist with the 1031, or is it something that someone can do by themselves?
No, you absolutely need to hire an independent third party to serve as your qualified intermediary. And there's a multitude of people who are disqualified from acting as your qualified attorney. And that includes your attorney, your accountant, your realtor, your investment banker, your broker, any direct line relative, and any employee. None of those people can serve as your qualified intermediary.
Okay. The next one's sort of related. Can my LLC be the qualified intermediary?
Nope.
Simple, concise, and good.
I like the easy ones.
Yeah.
Are the funds held in an interest earning account?
We have that capacity, but most of the time that's on the much larger transactions. Usually we're talking a couple million and up.
What if the replacement property cannot be closed for unknown or unexpected findings after the 45 days or 180 days?
So for the 45 days, that's why the IRS allows multiple identification of property. So if I get a client that sends me their ID and it's one property, I always ask them, are you sure? Put a backup and put a backup to your backup, because real estate, real estate's funny. A lot of times it doesn't close. So that's why they give you the flexibility there. Once you pass that 45th day also, you cannot add or change any of the identification. When it comes to the let's say the deals falling through, there's a very, very narrow scope within the regs that allow for a exchange to be canceled in the middle, and they call it a material and substantial contingency. But the scope is so narrow that it's almost impossible to meet. But that, again, that's when the attorneys get involved and make sure it meets that equation. But usually, yeah, once you're identified and past day 46, you're locked in till day 180 to the properties you identified.
This is an interesting one. When living in a two-family house with one unit being my primary residence and the other apartment being a rental, when selling the house, can I claim a residential exception for my apartment and do a 1031 exchange for the rental unit?
Yes.
Go ahead, Kayla.
Yeah, I love these. We get them a lot. I'm currently in San Diego coastal, so a lot of ADUs, right? Different properties that have split, or even a two-family. So we call it a split treatment. Let's say that property sells for $1 million and you evaluate based on square foot. They're mirror images of each other. So that would be $500K for the primary residence and $500K for the investment portion. When you sell that property to the one buyer, the $500K gets the exclusion for your primary under Internal Revenue Code Section 121 if you have gain, which consists of $250K for single filers and up to $500K for married filers. So you're getting a win on the primary portion, then splitting the other $500K 1031 exchange portion. So you pocket that $500K and you get to exchange the other portion out. So that's my favorite exchange to do. I hope to do one for my personal investments down the line. But yes, they are
Very
done.
cool. Nice. And it looks like this might be the last question. Of course, if you guys have others, please type them in now. Or, of course, I know that Jim and Kelly would be happy to answer them by email at the end here if you think of something later down the road. Can replacement property eventually be used as a primary residence?
Yeah, so I think we briefly covered that. I was speaking really fast. I apologize. So if you do an exchange and you buy replacement property, you have to wait 2 full calendar years before you can claim it as a primary residence. So it has to maintain as an investment for those 2 full calendar years before you claim it on your taxes as a primary to move into it, at which time it's your primary.
And just a little add-on to that, you can't then change it back to an investment property and 1031 it again. Once it's your primary, it's your primary.
That's a good distinction. All right. Well, I think that is it. I see one more question coming in, but while we wait for that, do you guys want to give any last comments or your contact information so that people can follow up after this session?
We've mentioned it 5, 6, 7, 10, 15 times. Contact your tax advisor. We can provide a lot of information, but by law, we cannot provide legal or tax advice. And quite honestly, your tax advisor probably does 1 or 2 of these a year, maybe 3 or 4. It's good for us to get on the phone with them. We can get them up to speed. Remind them, hey, this is this, this is that. A lot of times we'll have a conference call with the client and the tax advisor, followed by a call with the tax advisor. So they're like, wait, what do let's make sure I'm on the same page. And it's fine. They do 1 or 2 of these a year. We do 1 or 2 a day. And we've been doing it for 10, 20 years apiece, so our level of, this is our subject matter. And so we're there to not just help the client, but help the advisor as well.
Yeah, agreed. Collaboration is the key here. So any questions you have, we're happy to help answer them. I don't know if anyone ended up entering stuff in the chat there or not, but I exited that. So sorry, I can't see it.
No, people are just saying thank you, very helpful, and we've covered most of the questions. So yes, I will echo them. Thank you so much. I appreciate you both taking your time out to share this with us. This is great. And for everybody else who is watching, as I mentioned, we will be sending out a recording of this, and we are always here to answer future questions. So thank you so much, and hope to talk again soon.
Thank you.
Thanks, everybody.